Is the Bajaj Allianz Life Smart Wealth Goal V Wealth variant the right choice for your financial aspirations? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So, this is a non-participating life individual unit-linked single unlimited or regular premium payment plan. Now, let us take a look at the features available under this policy. You have the option to receive your maturity benefit or death benefit in installments with return enhancer. You have the choice of 5 investment portfolio strategies and 18 fund options to choose from, and you also have an option to reduce your premium or to change your premium payment term, and tax benefits are applicable as per the prevalent tax laws. Now let's move on to understanding the benefits available under this plan. So first is the maturity benefit, which once the policy matures, the policyholder will be given a fund value as on the date of maturity. That is the maturity benefit. Now, death benefit is something the nominee or the legal heir gets if the policyholder unfortunately passes away during the policy term. So, the death benefit here is higher of either prevailing sum assured or regular premium fund value or single premium fund value. And out of these two options, whichever is highest in value at the date of death of the policyholder, that will be given as a death benefit. Plus, in addition, either of these two options, prevailing top-up sum assured or top-up premium fund value, if they had any, out of these two options, whichever is highest in value at the date of death of the policyholder, that will be additionally given as the death benefit to the nominee or the legal heir. And there is also loyalty benefits available under this plan. First is the return of premium allocation charge. So at the end of the 15th policy year, the total of all your premium allocation charge will be deducted under this policy, will be added back to the fund as loyalty benefit. Another is the fund booster benefit, which is for limited or regular premium. So at the end of your 10th policy year and every 5th policy year thereafter till your policy term, so the maximum is 60th policy year. So fund booster here is a percentage of your average of the daily regular premium fund value during the previous 3 years, which will be added into your fund value as a loyalty benefit. Another benefit is your return of mortality charges, which on the date of maturity of your policy, the total amount of mortality charges deducted in respect of life cover provided throughout the policy term will be added back to the fund value. So these are all the benefits available under this policy. Now let us take a look at the fund options available under this plan, which are Equity Growth Fund 2, Accelerator Mid Cap Fund 2, Pure Stock Fund 2, Asset Allocation Fund 2, Blue Chip Equity Fund, Bond Fund, Liquid Fund, Flexi Cap Fund, Sustainable Equity Fund, Small Cap Fund, Dynamic Asset Allocation Fund, Individual Short Term Debt Fund, Mid Cap Index Fund, Small Cap Quality Index Fund, Nifty Alpha 50 Index Fund, Nifty 200 Alpha 30 Index Fund, Nifty 200 Momentum 30 Index Fund. Now all these fund options are categorized based on the percentage of asset allocation they have been given to equity, debt or money market, and also according to the risk profile each fund have, which can range from low to very high. Now let's move on to understanding the investment strategies available under this fund. So first is the investor selectable portfolio strategy. So if you want to allocate your premium based on your personal choice and decision, then you can opt for this investment strategy and choose from among the 18 funds to suit your investment needs. Next strategy is the Wheel of Life portfolio strategy 2. So in this portfolio strategy, at the commencement of the policy, the regular or limited premium pay policyholders and the top-up premium, if any you had, would be allocated to the funds mentioned, namely Equity Growth Fund 2, Accelerator Mid Cap Fund 2, Bond Fund and Liquid Fund in the proportion that they have mentioned in their policy brochure, depending on your outstanding years to maturity. So under the third strategy, which is the trigger based portfolio strategy 2, your premiums will be allocated between two funds which is equity growth fund 2, which is an equity oriented fund, and another is a bond fund, a debt oriented fund in a 75% to 25% proportion. So the fund value proportion may subsequently get altered due to market movement as well. So any appreciation over 3 times the value of your units is considered a gain and it's switched to the liquid fund. Later it will be switched to the equity growth fund 2 and the bond fund, such that after the transfer the ratio of the value of units in the equity growth fund 2 to that in the bond fund is restored to 75% is to 25% ratio. Another strategy is the auto transfer portfolio strategy. This strategy helps you to invest your money systematically by automatically transferring your money every month from a low risk fund to the fund of your choice. So your premium will be allocated to bond fund or liquid fund as specified by you. At the start of each monthly anniversary of this policy, a proportion of the fund value in the bond fund on that date will be switched to other fund available in the plan as specified by you. So another strategy is the capital preservation oriented strategy. So the objective of the strategy is to optimize the risk and return by investing across 5 predetermined funds, which are a mix of very high risk to low risk fund in such a way that the money is invested over the years along with the accumulated returns are subjected to lesser market volatility in the years closer to maturity. So these are all the investment strategies available to you, which you can choose according to what suits your needs. Let us take a look at the various charges present under this policy. So there are premium allocation charge, which is charged based on which policy here you are and what kind of premium mode you have chosen, yearly, single premium, and depending on that the percentage they charge will vary. And another charge is the policy administration charge, which also depends on what policy year you're currently in, what is your premium method, or like if you're in single premium policy holder or your limited premium policy holder. So based on all of that your charge will also differ. And another is the fund management charge, which they charge for managing your funds basically. So the charges here will basically depend on which kind of fund you have chosen and what kind of risk profile if it has. So if it has a high risk profile, the charges might be a little bit high compared to the low risk fund. So the charges can range from 0.50% to 1.35%. And there is a miscellaneous charge of 100 rupees per transaction, which will also be charged. And there is something called discontinuance or surrender charge, and it depends on your annual premium amount, and here you choose to discontinue or surrender this policy. But there is no discontinuance or surrender charge from the 5th policy here. And they also charge you mortality charge for providing you with life cover, which will be deducted at each monthly anniversary by the cancellation of units. So female policyholder will be eligible for an age setback of 3 years. So it basically depends on what gender you are and what age you're currently in. So based on that your charges will differ. So basically this policy comes with high fees and lacks transparency on why they charge this, on what they use it with particularly. But in contrast, alternative market linked investment options usually offer lower and even more transparent charges, making them a more appealing choice compared to the Bajaj Allianz Smart Wealth Gold V Wealth Variant plan. So now what we are going to do is we are going to understand the advantages and disadvantages of this plan. So the advantages are you can make partial withdrawal at any time after the 5th policy here, and loyalty benefits can be taken as periodic payouts throughout the systematic partial withdrawal method, and top up premium can be added back to your fund at any time except during the last 5 policy years, and premium allocation can be customized using the investor selectable portfolio strategy, and your units can be switched between funds at any time, which is applicable only under the investor selectable portfolio strategy. You can also switch between 5 unique portfolio strategies on any policy anniversary. And there is flexibility to modify your premium payment term and frequency. And if you are a regular or limited premium policy holder, then your premium can be reduced after the lock-in period. And you also have an option to lower your sum assured, and your maturity benefit can be received in installment over a maximum of 5 years. So these are all some of the advantages of investing in this policy. Now let us take a look at the disadvantages. So the disadvantages are your policy does not offer a loan facility, and the fund options here have similar asset allocation, making them appear redundant. So the return of charges here is unappealing as it ignores the time value of money. The plan also lacks liquidity during the first 5 years of the policy term. So these are also some of the drawbacks you need to carefully consider before deciding to invest in it. Now, as we have a basic understanding of this policy, let us now move on to the analysis part of the video, where we are going to evaluate the IRR, that is internal rate of return of this policy based on the benefit illustration provided in this policy brochure. So let us assume, just for example purpose, that a 35-year-old male purchases this policy with a policy term of 20 years. So he pays an annual premium of 1 lakh for 10 years with a sum assured of 10 lakhs. So by consistently paying your premium, the policyholder will receive the return of allocation charges at the end of the 10th year and a fund booster at the end of the 15th year. So at the end of the policy term, he will receive another fund booster, which is the return of mortality charges and his maturity benefit. So now we are going to calculate the IRR based on two future assumed rate of return, which is 4% for the worst case scenario and 8% for the best case scenario. So as this is a unit linked plan and its maturity benefit will depend on the policy's performance over time, we are going to calculate with the best and best case scenario in mind, just to give you a better example. But these returns are not guaranteed anyway and are not showing the limit of the potential performance of this policy. This is just for example purpose. So at 4% return scenario, the fund value is 14.64 lakhs, which results in an IRR of 2.47%, which might be comparable to the rate of interest you can get from a savings bank account, which if you take a look at the hint side, you just don't need to invest anywhere and take any kind of risk and just kept your money in a savings bank account if this is the kind of IRR this policy is giving you. But fine, this is the worst case scenario. For the best case scenario, at 8% return scenario, you can see the fund value is 26.25 lakhs with an IRR of 6.32% as per the policy's maturity calculator, which is also comparable to a low risk debt instrument like a bank deposit usually. So we are taking a lot of risk because we want a better risk adjusted return. We want an inflation beating return. But if it's giving you a return which is comparable to a low risk instrument like a bank FD, then what is the essential unique value addition this policy is giving us? Because both the IRR fall below the inflation rate, making it unlikely that the policy will help you effectively achieve your financial goal, because this in turn will impact your overall financial plan. Now, as we know that this policy is not giving us the desirable outcome we need, what we are going to do is we are going to compare the returns of this policy with an alternative investment strategy. So we are going to use the same metric as in the previous example, but we will explore the benefits by opting for a standalone term insurance policy and separately investing for our life's financial goal. This approach will demonstrate how investing separately can yield us better returns. So for example, let us assume that a pure term life insurance policy with a sum assured of 10 lakhs we have chosen, so which cost us an annual premium of 8,700 rupees for 20 years with a premium paying term of 10 years. So by choosing this policy, you save 91,300 rupees annually out of your 1 lakh budget you had for your premium with Bajaj Allianz plan. So this amount can be invested separately based on your risk appetite. So if you are a low risk investor, suppose you do not want to take a lot of risk, then you can opt for a public provident fund, which is PPF, which is a government backed fund giving you guaranteed returns as well as tax benefits under section 80C. So this PPF requires a minimum annual investment of 500 rupees per year for 15 years. So what we are going to do is the saved amount is adjusted accordingly in the final few years. At maturity, your PPF corpus will grow to 26.94 lakhs, delivering an IRR of 6.4 8.49%. This can be comparable to the 8% scenario in the Bajaj Allianz plan. Even then, it's giving you slightly a little bit higher return than the Bajaj Allianz policy, despite PPF being a debt instrument, which highlights its competitiveness against this market linked plan. So if you're a high risk investor, like you're able to take a lot of risk, then you can opt for ELSS, which is an equity linked savings scheme. It is an equity option which also contains a lot of risk, but if you take a look at its previous track record, you can see that by consistently investing in it for 7 to 10 years, it is able to even outperform its average 12% return in certain cases. So based on that, and also because it also gives you tax saving benefits, we have opted for this option in this example. So if you invest in ELSS with combined with term insurance, the maturity value grows to 55.73 lakhs. So after accounting for capital gains tax, the post tax value alone stands at 55.06 lakhs, resulting in an IRR of 10.65%. So this analysis clearly demonstrates that separating insurance from investment is a superior strategy. It not only provides higher returns but also offers us with better liquidity compared to the Bajaj Allianz Smart Wealth Gold V Plan Wealth variant. So, what is the final verdict on our analysis on the Bajaj Allianz Life Smart Wealth Gold Plan Wealth variant? Is it worth investing for the long term or not? As you can see from our analysis that this policy integrates market linked investment with life coverage, providing features like fund booster and the return of specific charges. However, upon further analysis, you can see that its return falls short compared to other market linked products in the market, making the risk return balance less favorable. So, if you're a long term investor and you want to seek returns that can outpace inflation, then you need to invest in a product that delivers above average return that can beat inflation. But this is a product that delivers below average return, which can hinder your ability to achieve financial goals. So, this policy may not be an effective option for long term wealth accumulation, potentially disrupting your overall financial plan as it also has a high agent commission. So, you can definitely avoid investing in this plan. But a better approach would be to opt for a standalone pure term life insurance policy for affordable life coverage, because even a high coverage can be opted by in this policy for a lower premium. So with the remaining surplus, with the surplus you save from this, you can invest it strategically based on your financial goal, risk appetite, investment horizon. So building a well diversified portfolio is essential for achieving your life's financial goals efficiently.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.